In this video, we're going to talk about hard money long-term rental loans. Coming right up. Hey guys, how's it going? My name is Sean, and on this channel, we go over real estate investing tips, strategies, and current events to help you learn more about the business and to help you become a real estate investing boss. And in this video, we're going to talk about hard money long-term rental loans. What is it? Who is it used for? And why should I care? Well, if you've been investing in real estate for any time now, you're going to know how important financing truly is. Almost nobody buys homes with pure cash. There's always some kind of debt component to it. So for example, if you were to buy a house through a traditional lender, typically you're going to put down 20% of your own money, and the bank will put down 80% of the money as long as you pay them every single month for the mortgage. Well, after a certain amount of loans, the banks aren't going to give you that loan anymore. They're going to think that you're too much of a risk. Instead of congratulating you for having over 10 properties, they're going to say, you're too much of a risk, we're not going to give you any more loans on single family properties. So what are you supposed to do at that time? Well, at that moment, you start looking into alternative financing solutions, and one of them is a loan product like the one I'm going to talk about today. So the way this works is that the lender will start to lend you money based on the property itself and not based on the borrower's qualifications. The lender won't care that you have 10, 20, 30 properties. They're going to care if the property itself can sustain itself through this mortgage. Yes, the price is going to be a little bit higher. That's because you are a more risky client than a typical borrower would be. And besides having too many loans, some of the borrowers don't qualify for a traditional loan because they don't satisfy the debt-to-income requirements that most banks have. The debt-to-income requirement just means that the ratio of your gross income from your job divided by your total debt, which is your mortgage, your insurance, your taxes, any association dues, any car loans, any other loans you might have, has to be below a certain threshold. And typically the ones we see is about 43%. And so how does the whole thing work? We can loan up to 75% of the purchase price of a new rental property if it's in moving condition already. If the property needs some rehab work, then it's probably better to buy it using a traditional hard money loan or a bridge loan, fix up the property, and then refinance out with this particular long-term rental loan. If you do a refinance option, the maximum leverage that we can give you is 70% of the appraised value. And just now I mentioned that your personal debt to income ratio doesn't matter that much when it comes to these long-term loans, but the debt service coverage ratio of the property matters a lot. And it's a very similar concept, but a little bit different. Your debt to income ratio is from your own personal income. So if you're working from a job, you have other income sources from other properties, that's your income. But debt service coverage ratio only looks at the property itself. We look at the net operating income divided by your PITIA, which stands for your principal, interest, taxes, insurance, and association dues if your property is in an HOA. That debt service coverage ratio needs to be above 1.15. So you need to have a significant amount of money that's being generated from the property to be able to qualify for this kind of loan. And yes, you can use alternative renting methods like Airbnb or short-term rentals to satisfy that DSCR requirement, but we're going to lower that threshold for the amount you can refinance just to 60%. And if you're a borderline case where your debt service coverage ratio is just at around 1, then we can do it, but we're going to have to charge you about 0.5% more on your rate. The interest rates and fees differ, but here are some of the levers that you can pull to get a better rate for your property. The maximum loan to value is going to be 75% for a purchase and 70% if you're doing a cash out refinance. But if you lower that amount to just 65% or to 60%, then you're going to see a significant drop in your rate. For example, if you drop it from 70 to 65% for a cash out refi, your interest rate goes down by 3/8%, which is 0.325. And if you drop it again to another 5% to 60% LTV, then your total rate will drop by 5/8%. Having a better credit score will naturally drop your rate as well. The maximum credit score that we care about is 740. So if you're at 750, 760, then your rate is not going to change. You're going to get our best rates. And our lowest rate that we'll accept is 680. So if you're at 680, then you're going to have our highest rates. But if you're a borderline case, 660, 670, then we're going to have to talk to you to see if we can make an exception for your case. But there are multiple thresholds between 740 and 680. And for every threshold, your rate will go up by 0.25%. The difference between the best rates and the lowest rates is going to be about 0.625 based on your credit score. Your rate will also change if the property that you're trying to buy is not a single family residence. So if it's a multifamily property or it's a condo or a townhouse, then your rate might increase by about 1/8% or 1/4%. These loans typically come with a prepayment penalty of 3 years, which means that if for whatever reason you sell the property and pay off the loan, or you refinance into a different loan and you pay off the original loan, then you're gonna have to pay a prepayment penalty if that loan was paid off before the prepayment penalty schedule is over. And the way that prepayment penalties work is it's based on a 3-2-1 drop method. So on year one, if you prepay your loan, then you're gonna have to pay 3% of your total loan amount. If you prepay your loan on year two, then you're gonna have to pay 2%, and then on the last year, 1%. And after that, you pay no fees. Now, if you wanna lower your rate even more, you can opt in for a 5-year prepayment penalty, which means that you're gonna be locked into this loan for at least 5 years before you have to pay this penalty. And it will drop your rate by 0.125, so 1/8%. And that's gonna be on a 5-4-3-2-1 schedule. So if you refinance your property in year one with a 5-year prepay, then you're gonna have to pay 5% of your loan amount at closing because of this penalty. Now, if you really don't want prepayment penalty, you can actually buy that down. So baseline is 3. If you say, oh, I only want a 2-year pre-penalty, then you can actually pay for that. Your rate will increase by 1/4% for every year you don't want a prepayment penalty for. So if you say, I don't want a 3-year pre-penalty, I only want a 2-year prepayment penalty, then your rate is going to increase by 0.25%. But unfortunately at this time, I don't think we can give away no prepayment penalty loans. It's going to be at least 1 year. And to go from 3 to 1 year, you're going to have to pay 0.5%. Two other ways that your loan can go up is if you're doing a cash out refinance. So if you had a loan before and you just refinance into ours, then we're not going to charge you that much. But if you're asking for cash on hand, then we're going to charge you about 0.5%. And if your loan is under $100,000, then your rate will also go up by about 0.25%. And these numbers are all true as of August of 2020. So don't be surprised if you're watching this video in 2022 and you're asking me, hey Sean, I thought you said these rates were so and so. They could go higher, they could go lower. We don't know. So be sure to schedule a call with me to ask for the latest rates. And unlike traditional hard money bridge loans, this is a 30-year loan. So we have the 30-year fixed plan, which is the most expensive one. Then we have a 7-1 ARM, which means that for 7 years, this interest rate is fixed. And then every year after that, the interest rate can adjust based on some index. And the third one is a 5-1 ARM, which is the cheapest option, which says that your first 5 years are fixed, and then every year after that, it adjusts based on some index. These loans are more expensive than traditional ones, but for some investors who have a lot of loans and aren't able to get more debt, this could be a great solution for you. If you guys have any questions, feel free to contact me. My contact information is down in the description below. And let me know your thoughts with the long-term rental program. If you guys have enjoyed this video, be sure to smash the like button, subscribe to the channel, and hit the bell notification to get more videos just like this one. Thanks for watching, guys, and I'll see you next time. Take care.